Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, how you going? Phil Tarrant, host of the Smart Property Investment for the sixth and final instalment of our special series on the Fast 50 report, which we have just unveiled 6 days ago. So Monday was when the report came out. It's now Saturday. We've come in to record the podcast. We've gone through a whole bunch of different things. Most recently, we did Best of the Rest yesterday. I hope you tuned into it, or if you're watching this on the YouTube or anywhere on the videos. Really good discussion around all those suburbs which didn't make the list and some of the reasons why and how you can interpret that and take decision around it. Prior to that, we did a good discussion around metro versus regional. So we've skirted around the numbers. We've given some insights and interpretation on those numbers, how we've come up with this particular ranking, the Fast 50, where to put your money today for the best capital growth in 2025. And we've just challenged the efficacy of the report, tried to give some insights into why it's probably ended up the way it has, the fact that it is heavily weighted. At least 50% of all suburbs are in Western Australia, mainly in Perth, and there's good reason for it, and that lends itself to the methodology of this particular report. And we've touched on it as part of this discussion where we've looked at some tactical applications of it. Most people are going to get this report and go, wow, that's really, really interesting, and they're not going to do anything with it. So I want to talk today about, okay, what next? You've got the report. How can you use it to either accelerate investment decision-making or start forming some investment decisions around it? Outside of my pay grade, I'm but a humble journalist. I don't do much other than talk on podcasts to people that know around property. Finally, I've been able to find someone who I think can sometimes get it right. That's Paul Glossop at Pure Property Investment. He's and his business have been the partner of this particular report. He's going to give me some tactical insights into what do you do now you've got the crown jewels of information. Paul, information is only as good as how you choose to act upon it. Discuss.
Philip, perfect.
That's your essay.
I'm not even going to go down. I was
perfect in action always trumps perfect. Imperfect action always trumps perfect in action. 90% of winning is beginning.
This is it. This is all we're talking about today. This is about, hey, do something or do nothing.
Just do it.
But we'll sit back in 12 months' time and we'll unpack last year as well as the next year.
Yeah.
And unfortunately, you don't be the one thinking I shoulda, coulda, woulda.
And that's what we spoke about when we launched this special series of the Fast 50 about winning is beginning.
Yep.
We used a lot of those cliches and analogies around gonna, wanna, coulda, shoulda, didn't for whatever reason. There's the merchants of excuses, or there's the merchants of action.
And it's the merchant bankers.
It's the merchants of Venice. There's a lot of clues there if you're dialed into your literature. Tale of Two Cities, another great thing with a property view of it. It was the best of times. It was the worst of times. This is the center of our discontent. The Capriots and
all right, moving on. You're losing everyone.
No, I'm not. They're sitting there going, "Geez, he's well read, that bloke."
Amazing.
Yeah, I have so many people fooled.
Only fools and horses.
No, only fools and horses. This time next year we'll be millionaire. I have a lot of people fooled that they go. You get feedback sometimes. I find it a bit. And I'm obviously a transparent person. They go, he's able to talk about all this stuff.
He does have many leather-bound books, ladies and gentlemen.
I do have a lot of leather-bound books.
A lot of which were enjoyed via cockroaches over their storage timings.
Let me give you a hot tip as an investor, as
a collector,
as an investor with a diversified portfolio. When you store your antique books collection, make sure it's cockroach-proof. There's one thing you need to know,
and don't ask Phil as to how to cockroach-proof your book collection because he doesn't know.
No, it's got to be airtight.
Yeah.
Anyway,
yes.
But you've got to look after these things, much like your portfolio, Paul. And what we've given in the Fast 50 is the keys to the city.
They are to a few cities.
To a few cities.
Yep.
Another great sort of metaphor we can use here. We love a metaphor on the Smart Property Investment Show.
Can we just get to the point?
We've given you the keys to the city. You need to go and open the door.
Yeah, far out.
God.
It's not going to stop, is it?
No.
Look, I think if I was going to open up this podcast with something is really, really timely, I just got off the phone probably about 2.5 hours ago before we started the conversation about recording this podcast and about the content, etc. With one of my team at Pure Property Investment, we just finalised finance for a property that we bought. And I'm going to give away a suburb here that we just bought a property in, and I'm going to give away a story that goes behind it.
I bet she's in Perth.
Yeah, well done. You started with one key to one city and one suburb. I'm going to tell this suburb. So where I'm getting at with this was someone who bought their first investment. Now, they reached out to us at the end of January 2024, and they spoke to us at around about April 2023, and they didn't have enough money. And I was short with them in that time and said, look, your intentions are right. You're on the right track. We just can't do anything with the means. And we could have done something. And this is probably a very big one here, because this sort of is the poles of opposites, is saying you do something is better than doing nothing. Well, they had about $48,000 in 2024 to their name to use as a deposit. They had a job. Their job was going to get a pay rise. They're also going to get a bonus at the end of the year. And then they ended up getting that bonus that pushed their total budget, or their total cash available with a buffer in addition. They had ended up having about $65,000, $68,000 at the start of January, and they got a pre-approval for $350,000. Now, I'm not going to suggest that that's a budget that I like to work with very often, but it was enough. It's enough to get started if you're ready to get started. Now, that property has only just been bought. It was bought about 2.5 weeks ago. We just got finance approved, and it's in a suburb of Wellard, which is south of Perth, down towards Rockingham, Mandurah region. Now, this property was bought, and I'm going to give away the numbers. I'm going to give away what happens when you actually put a plan and you actually execute. This property was bought for $317,000. Property's going to rent for $460 a week. I'm not going to talk about what the property type is, etc., because that's kind of irrelevant. But I guess where this story gets really exciting and interesting for this particular person, and if they're listening, they'll know exactly who they are. But we just got off the phone this morning with the broker who finalised finance, and not just to say, great, congratulations, finance is approved and you're ready to settle. But this property that this person planned, they saved, they worked, and they put the money aside and they bought this property. They got a bank valuation, an official bank valuation of $460,000 today on that property. Now, it was under contract 2.5, 3 weeks ago. The property was bought off market. They got a bank valuation on that property, the best part of $140,000 above purchase price. Now, I'm not suggesting that happens every day of the week, and I'm not suggesting that's something that we bought with the intention of happening. But what that's just done is that there's probably now going to be an opportunity for that same person in 6 months' time to potentially settle on that property and maybe refinance out of that particular purchase another 100-odd K in equity to then recycle, because their actual income will support another investment. What they had limited was deposits. Now, they've actually spent the best part of 2 years prior saving. They got a bonus. They kept saving last year. They got themselves to about that 65K mark, got that purchase for $317,000 in a property in Wellard in Perth, and now they're on their way to potentially buying a second property within 6 months thereafter, on their journey, getting busy, taking action.
So taking action is good, but I've got to query that.
And again, I preface that by saying this isn't a strategy which we would expect or advise to say, push your broker to say, go and get a higher valuation.
You know, to be a cynic, which I'm obviously not, but it's part of my professional discipline is to query and be curious.
Yeah. Sounds like BS.
Yeah, well, of course it is, but it sounds like the valuation is BS, right? Like, so I would go 140 grand.
Yep.
Higher than the purchase price, right?
Yep.
So either the value has got it completely wrong, and what is going to be the ramifications of that for the bank, right? Because, God, and you see these in markets which are growing, valuations, it's very different in softening markets. But, mate, the real estate agent's stuffed up, but you went directly off market, right? Was it off market via
a vendor directly?
Via a vendor directly? Like,
zero agent involved.
Why do they sell it so cheap? Did they not know? And the argument would be, don't sell your house directly to a buyer's agent. Use a. I've got to be pro real estate agent on this one, right? But this is what real estate agents would say, right?
This is where the argument is. The representation of real estate agent probably would have buffered a lot of this. And I'm not here to say that we necessarily tore the pants down and said, look, hey, this is what we're going to pay and this is a good price for you. But effectively, we got someone approached us. They said they want to sell the property. We said, look, hey, we'll pay this for the property. It ended up being I think we ended up buying about $7,000 or $8,000 below what the original discussion point was, which ended up being $317,000. And lo and behold, we got a valuation up there. Now,
what did you think it was valued at?
I think, look,
Did you think you were buying at a fair price?
Speaking of my buyer's agent team, to be completely honest with you, we sort of thought that the market value was sort of circa plus or minus 25K of the 400K mark. That's where probably, if it was advertised correctly, styled and put on the market and sold to an owner occupier, we thought it was plus or minus sort of 400K, maybe 390, maybe up to 430. The 460 was an above valuation. Where we bought it was dirt cheap. And again, I'm not suggesting that if someone came to me and said, Paul, I want that one again, $317,000 full stop is very cheap.
It's
we
an
don't
outlier,
buy at that price
right?
point very often.
But
My point is, taking action for this person, they could have sat back and said, I don't have enough deposit. At the start of this year, they could have come in and I could have said to them, look, we probably, and I don't normally advise in that price point very often, but I knew that where their position was, they wanted to start, they were young, they were ambitious, and they kind of weren't going to take no for an answer. So they wanted to get started, and I said, look, if you're going to do it, we can do it.
Yeah.
I probably would have preferred to be working with a budget of about $500,000, maybe up to 600K, which would have resulted in 90 to $100,000.
It's a great outcome for them, and no doubt, I don't know the details or the sensitivities around the sale, but it sounds like they needed to sell the place
correct.
quickly, right?
Yep.
So did you facilitate a fast
Facilitated
purchase?
it happened, no fast, no. Obviously, they don't pay a commission, they don't pay advertising fees, they don't sell the property. We bought it, it was done. But I guess going back to the theme of this last podcast, this Fast 50, is that market has grown significantly in value, well in excess of 10, 15% annualized. We're seeing a rental yield on that particular property on the purchase price is going to be north of 7%. So cash flow wise, even if they've recycled equity out, the property's going to sit quite comfortably in a cash flow position.
And that's their first investment.
That's their first
Okay,
investment.
so they're about taking action for the first investment. The issue you've got, though, is like you rock up at the horse races for the first time, you win big on a trifecta, and
there
you
is
think
a lot
that's
of
easy,
there
right?
is certainly a lot of that conversation which has already started, because we had a long meeting with this particular client this morning to say, this is an amazing outcome. Look, this is a one out of the box. We're not going to be here, and we certainly didn't suggest this would have happened prior to it happening. But what it comes back down to is that fortune favours the brave. You do not get outcomes by sitting on the sidelines and holding a report in your hand saying, this is a report. Yeah. You need to do something with it.
Yeah, if you're not in the game, you're not going to be able to play the game.
You sit on the sidelines and you criticise. And that's ultimately what everyone who's not going to take action will do. And for me, when it comes down to this report, and the same as last year's report, and it'll be the same in next year's report, I dare say, Phil, is that we're going to come back, we're going to divulge and digest everything that happened, and there's going to be a lot of people saying, man, I had the means, and I was considering it, and I kind of just let life get in the way. You've got to prioritise what you want to get, because if you want to get an outcome, and you want to get a financial outcome that's going to put you in a better position, you need to think, okay, am I in a position to get moving? If so, I've probably got a lot more tools than most, so let's start applying those and get some action.
And that's a good point. This is a tool to help you maybe accelerate decision-making, support decision-making, give you confidence to make decisions. And, I was chatting with my banker just yesterday and pretty much going, I know in 10 years' time, I'm going to look back to this moment in time, 2024, going, why didn't I do more stuff?
Yeah, just like last 10 years.
Just like the last 10 years, right? Yeah, when I could have, I can now.
Yep.
And when we kicked off this specific series around the Fast 50, we had a discussion around, I think you purchased 3 properties based on last year's report.
Correct.
On the recommendations coming at soon to be 4, whereas I did nothing. Mm-hmm. I think you had a considerable uplift in your properties, and my money got wasted on stuff which
you broke even.
I broke even.
I think you just broke
I broke even on my share portfolio. I'm back to even, right?
Yeah.
Because I put the dough in shares, you put it in property, right?
Yep.
Anyway, but that's so I did take action, but I didn't take action based on property
information and knowledge that if you're honest with yourself, you're a lot more confident in property information than you are in shares.
Yeah, should have. The money I have in shares, I could have easily.
But you are a gambler.
Well, I'm not a gambler. That's the difference.
Well, I don't know if you're true to yourself then, if that's the case, Phil.
Me? I don't gamble.
Well, you just told me that you put money into something that you had no idea what the outcome would be, and essentially that cost you money.
Bank stocks, Qantas.
So are you suggesting that bank stocks are foolproof, Philip?
Yeah, that's what they tell me. Like they make all these profits, and they're making so much money. But I'm told now by bankers that they're not making any money on mortgages at the moment.
I know. What are they going to do?
Which scares me.
Yeah. Then what?
Scares me. It scares
Fees go
me.
up.
No, I reckon they're just, I've been talking a lot about it, about taking action, right? Like a lot of people are sitting there going, Interest rates are high.
They had a very good time the last previous few years when
they
interest
did.
rates are down, their margins are fatter, and
Yeah.
obviously they're at a squeeze point. And word to the wise, and anyone's listening, you and I spoke offline on this, Phil, is that once we start seeing this interest rate cycle drop down, unfortunately they're probably not going to drop their rates as quick as we would like because the margin needs to increase to make sure that the bonuses increase for them.
That's a bit cynical.
A little bit cynical. I learn from the best.
Yeah, that don't. Maybe some do, and again about taking action, right? Like if I got this report, my hot little hand going, geez, this is a good report. I'm going to do something about it, right? Well, you got to get your finance pre-approved before you do anything, right? You got to get a lot of things sequentially right before you can do anything about it. So a lot of people look at this and go, yeah, look, Wattle Grove in Perth. I've never heard of the place before. Is performing really well. 10.2% quarterly growth.
Quarterly growth.
2.4% average annual growth.
There you go.
And last 12-month growth, 16.8%.
It's on a tear.
You probably missed it.
No, you're far from it.
You reckon?
Yeah, well, I mean, you tell me how something can grow annualized over the last 10 years at 2.4%. It's just done 10%, give or take. Oh, sorry, how much did it do in the last 12 months? 11, 12%.
16%.
And then it's done, last
10.
quarter's done 10.
Yeah.
It's on a much more of an increased trajectory than it is a decreasing trajectory. And I'd probably also suggest that the yield in that market, not seeing, I've got my computer closed for everyone who's looking in front of me, the yield would be 5%, if not a bit better.
4.6.
There you go.
$600 a week.
And I'd probably argue that might be a little bit delayed. One thing you know about rents right now is that they're on a big growth trajectory. Rents are usually about a 12-month laggard.
Historic stuff.
Yeah. But that being said, I guess where we're going with this is that if you really can't be the person to say, okay, well, the order and the sequence, you have to take action. And Phil, you talked about one of the first steps is figuring out your finance. Now, if you've got a 600K market there you're talking about for Wattle Grove, the reality is that you've got to figure out, okay, well, if I'm going to buy in Wattle Grove and let's say I'm working off the minimums potentially, if I'm working off a 10% deposit and I'm working off a 4% stamp duty and I'm working off about a 5% total required for closing costs in general, so 15% of the purchase price, you're talking about 60 grand for deposit, you're talking about another 30 grand for all the other auxiliary closing costs. Give yourself another 10 grand as a buffer. That'll include a buyer's agent if you throw them into the mix as well. 100 grand will get you into that market. Now, 100 grand, if it's growing at 10% quarterly, that's 40%. Even if you get 10% annually out of 600 grand, what is that annually, Phil? Do your quick mental math. That's $60,000.
Yeah.
If it gets 10%. Now, you're talking about investing $100,000 on a $600,000 asset. Now, it's at the moment, that's likely to be a $660,000 asset by the end of the year if it goes on anything similar to that trajectory.
See, the challenge you have with all this, and there's 50 suburbs here which in conjunction with an overlay of data with the recommendations from some of Australia's leading professionals have gone, look, these places should perform pretty well. But then the scenario you just said, right?
Yep.
100 grand in, you're going to, if you make 10% annually on that.
Well, just in the next 12 months.
The next 12 months, right? Like people just go, you can't make money that easy. It's too hard. Something's wrong. It's a Ponzi scheme.
Yeah.
There's the numbers just don't add up or stack up. Because it's hard to make that money anywhere else.
It is, and I think
so it's about timing, right?
A few truths with that is that it's not money in your bank that you can go and spend.
No,
it's not walk around money.
No, it's not walk around. Do you see that?
But I think that's
a lot
the
of people
point
are
here.
just going, you idiots.
Idiots. But it's not like when we talk about equity increase. So you go from a 600 grand asset to a $660,000 asset with a 10% increase. Yes, technically that is exactly what happens. Now, is that something that you expect to happen annually? No, you just recited, Phil, that the average annual growth over the last decade was 2.4%. So right now we're on track to see 4x, 5x, 6x, 8x, 10x maybe its average 10-year growth. Now, that doesn't happen forever, but what the whole intention of this report is where to get the best outcome in the shortest period of time. And the reality is next year will likely be different markets, so on and so forth. And over the last decade, Phil, as we've been recording different podcasts, we've talked about almost every single market in Australia that's probably quite prime to invest in for that particular point in time.
Yep.
That's where it's at for anyone who's listening. Say how to apply it. You apply it to get that outcome quicker than what you'll get if you bought in your own backyard in areas that you just, because you know it, doesn't mean it's going to better perform these markets in this report.
So it's a good point. So what you're getting with this report, if it's accurate, and I'll preface that with maybe it's not, but we've done our best to create it. But let's just assume that based on last year's one, that the way we've put it together should hold true. So let's just hopefully assume that it goes okay, right? So what is the practical application of this? And this isn't like buy these properties in these areas and hold them forever, right?
No.
This is about how you can you're buying optionality if you take action based on the data we're presenting in these reports in these suburbs. So if you can get the immediate capital uplift in taking action and buying in these areas, you have equity, right? That's what you're manufacturing is equity. Now, equity gives you optionality or choice. You can choose to leave that equity inside the property, or you can extract that equity and use it and deploy it elsewhere. So there's a lot of different ways that people will get a practical application from taking action on those reports. And talking about that example inside of Wattle Grove, for a lot of people who are new to investing, the price points we're talking about here are probably the bottom sort of
Probably bottom
quartile,
third
bottom
possibly,
third of areas you can invest in Australia in terms of dollar values.
Probably
right?
in dollar
and
values,
we're
yeah.
not advocating that property investors should all be investing in
Not at all.
lower price
Not
stuff.
at all.
That's not
And
the
we've
point
talked
of it.
about that. There's good and bads
It's
in
good
higher
bad.
and lower.
Yeah, all over the place, and it depends where you are on your investment journey. But if you're new to property investing and you want to get, and you've done the hard graft to save some dough, to invest in property, and you want to maximize that as much as possible, so you can go through the perpetual program of accumulating property, you deploy your dough in these areas. It's going to give you optionality and choice to choose to continue to grow.
Yep.
The flip side of that is that if you put your money in the wrong assets, you're going to be hamstrung and you're not going to be able to extract that equity. You might even go to negative equity, which means there's going to be an inhibitor to growing wealth through property.
Yeah.
So it's about putting your smart money in areas which are going to get you a smart outcome.
Yep.
And every single property investor I know largely wants capital growth. Depending where you're on the cycle, some people might want more yield and capital growth or whatever. But this is about where to put your money today for best capital growth tomorrow. So you can do something with the mo.
Yep.
Do something with the dough. Do something with the increased equity. And some people might just want to leave it there and just go, hey,
Yep.
sweet, no worries.
Yeah, no, completely, mate. And I think that's the choice depending on the strategy. And I think going back to the theme of this podcast and how and when to do it is that you can speak to your broker or your bank first. For me, I actually like to speak with clients before they even speak with their broker or bank sometimes, because what that allows us to do is probably deploy and more so potentially strategize finance options and discuss those, because I don't like necessarily people coming to me saying, oh, my broker's sort of set me up with a 20% deposit, no LMI, but it's my first investment. It took me 6 years to put this deposit together, so I'm really going all in on this, and I've only got a really finite borrowing capacity. Sometimes that is correct, but other times you say, well, if it takes you a long period of time to save that first deposit, you might be well inclined to say, is it worthwhile considering capitalising your lender's mortgage insurance and go down the pathway of a 10% deposit, so you can preserve a bit of that cash, keep it as a buffer, park it in an offset account. And I sort of ran through a lot of different technical aspects there, but I guess what I don't need people to do is necessarily write that down word for word. But there are so many different ways and strategies which we like to discuss. And then from there, it might be saying, go back to your broker and maybe speak about this option. Vice versa, if you've already got your loan structure set up and you think you've got the absolute best advice, then you need to get busy. And getting busy is trying to think, okay, don't just think, go to your broker or your bank and figure out what the maximum borrowing capacity is and go buy a property at the top end. And also conversely, it's not saying, hey, if you can borrow $1 million, don't buy two at 500 grand just for the sake of diversification, because sometimes that is a lazy person's way to essentially say, look, I'm just not that confident in the decisions I'm making, so I'll buy two instead of one. We have to then dig deeper to figure out what are the cash flow provisions that we need. What else do you have in your portfolio? How long do you have to work with? Are you maybe planning on building a granny flat or maybe subdividing one of these assets further down the track? There's a range of different strategies then that come into the fold to figure out what properties, which locations. And this top 50 report, or this fast 50 report rather, has a range of price points, a range of locations. And within those price points and locations, there are a huge amount of different property types, which may or may not fit your criteria. And then when it comes down to it, you've got to buy, and ideally you buy well. Don't just buy in a market because it's one of the better markets to grow in value. You still want to buy ideally at the lower price point and the highest.
Yeah.
The
So
most
it's still
desirable.
asset selection. It's still the price point of that property. You gave us an example of Wellard, right?
Yep.
Like, do they exist everywhere? No, they don't. Is that the unicorn that most people want?
Possibly.
Absolutely, right? So yes, these are suburbs, but there is so many different dynamics in and around it, and people need to be careful. But that also is sometimes a stifling mechanism for decision making, because people go
Big time.
oh yeah, look, Wattle Grove, which we were talking about now, or any of these other places, right? Like going, okay, I know the place now, but there's all these decisions I need to make, and I don't know how to do it.
Yeah.
Or I can't do it. I'm unsure. I don't have enough confidence, therefore I won't do.
Yeah.
And this all comes down to mindset.
Yeah.
And
Yeah, absolutely.
people talk about it all the time, property mindset and stuff. It's done to death, but there is something to it.
Yeah.
But I wouldn't overcook it either, right?
No.
It just...
And this is the big part, is that like if you looked at it, Phil, and you say it a lot, mate, and I think we say it a lot in this podcast, is majority of the best investments you've made and probably I've made in the property space, to be honest with you, I don't look at it more than once. I look at it like, that's a deal. And then from there, the phone call basically goes to either my buyer's agent team saying, get me the contract, and my broker saying, I'm going to be buying this. Can we start the process?
Yeah.
From there, it's saying, it's off to the races. Let's get busy.
Yeah, yeah. And then that's the decision made.
Yeah,
right.
decision's made.
So as
Move
a
on.
property, and me being a certain type of property investor, and I could look at, I don't know how many properties I've bought, lots. Sometimes the decision making is like that. Sometimes a little bit more deliberate, right? Depending sometimes on if I'm spending a lot more money on something, I generally do a lot more
Bit more
disciplined
due
due diligence on it. But you know, if I'm buying this sort of stuff, and that sounds really flippant, right? If I'm buying this sort of stuff, you know, 600, 500, 400 grand, whatever it is, I'll go, I know I want to do that.
Yep.
I've got the money available, or I've got some debt that I've created around it, which is pre-approved and ready to go. It's a completely non-emotional, calculated decision after that. It's to a buyer's agent, because I'll probably use a buyer's agent to get this stuff because I don't have the time, energy, and effort to do it myself, and or they can do it better than me. I'll just go and sort this out, and they'll call me and go, I got one, it's this. I go,
Yep.
yeah, go.
Yeah.
And then everything else just happens,
Yeah.
right? You
And
go, this guy does this guy does this. Tell me when it's all sorted out.
Here's a brilliant example, Phil. I can speak to an email that I got whilst we've been actually recording this podcast from a client of mine who's actually runs one of the biggest mortgage brokerages in Australia. I don't know if I should or shouldn't give you his details or his company, but anyway.
You're going to plug him, are you? Is he any good?
He's one of the biggest and best, and I know he supports a lot of investors. I'll give a plug to the company, Strategic Brokers.
Okay. Never heard of him.
Never heard of them.
Must be good.
You dig deeper and you'll probably figure out who they are. But in short, he's a client of ours. I got a call from him yesterday saying, Paul, I've just liquidated a couple of properties. I've got some spare cash. I don't want those loans to settle. I need to port those loans. I've probably got capacity for probably 3 properties in that circa 600K. He said, I'm a bit light on in Perth. I've got one, which we already bought one for him last year in Perth. He's like, mate, I need to get 3, make them happen. Briefed my team, figured out where and what we needed to look for, sent him a property overnight, came back, had a look at it, sent me a text saying, good to go. That was literally the conversation. So the text message I've got and the email to my team is good to go. So my team said, okay, thank you, X. Please send me through your buying entity. We'll get it happening. That's it. That's the conversation. This is someone who's got a very large property portfolio, has done very well in properties, quite diverse. But that's how people with the correct mindset and strategically are ready to roll. That's how they operate.
Yeah, and your ability to make decisions accelerates the more you do of it.
Yeah.
So you must see like people new to investing, never invested, they've probably got to hold them
Far
hand.
more education.
Probably get you 1,000 questions around.
Which
this,
I'm
that,
happy
and
to
the other.
answer because I know we've all been there and we know how important it is because once you get good at it, you can pick it.
Yeah. But the more you do of it, then you just go, okay, well, you go.
Yeah.
Do it.
And there's
Good to
trust
go.
in the relationship as well.
When there's trust in a relationship, terms become negotiable. That's Tom Panos. I'm seeing Tom Panos soon.
There's another property investor for you.
He loves it.
Loves
He's
loves
big
property,
in
loves
property.
investing,
Everyone knows
loves
Tom.
everything about
Yeah.
property.
When there's trust in a relationship, the terms become negotiable.
Yeah, I don't necessarily agree with that.
No?
Phil. No, I actually completely disagree with that. Some of my best clients don't negotiate.
No, but I think the terms become negotiable.
Refer to the terms between myself and my client, the terms between
The terms
myself
as
and the
in
property.
there's an element of trust, so therefore you might not need to do what you would normally do if there was less trust
So
in
you
a
think people
relationship.
get lazier?
No, I think people get confident, and there's an assumption if there is trust that if you're talking about a buyer's agent relationship,
Yep.
if there's trust in a relationship, typically what you would need to do with someone who was a new client that didn't trust you versus someone that does trust you, there would probably be a lot of accelerant factors they just go, okay, sure, no worries.
Yep.
Yeah.
Okay. And you're exactly right, because my mind was going a completely different way there. I was thinking that people potentially think that if there's trust, then essentially you're devoid of a lot of the steps that you'd normally go through. But to your point, you trust the process. So you're like, mate, you don't need to explain to me. I understand how it works. I've been through this. Let's roll.
And or if there's problems or issues, there's probably easier ways to remedy it. Right.
Yeah. And I'll give an exact point to that, but I did a development 3 years ago. I got a call from one of my tenants last night, FaceTime call. This is the kind of calls you want to get at 8:30 at night. They're not listening to this. They're from Canada. They don't listen to property investment shows. They're in one of my properties. Expensive rent. They rent, and I'm friends with them, so they called me directly instead of the property manager. I knew when I was getting a FaceTime call, it wasn't a call that I could not answer. Answer this call, I could see water streaming from a downlight on the second floor of this very expensive property that I built 3 years ago. As it turns out, there was a problem. Well, there's a problem with water. Obviously, it was leaking everywhere. From that conversation, I got on the phone to my builder, and this is where the terms, to your point, Phil, is this having really good people in the fold. I got on the phone to one of my builders who I use, so I'll give him a plug, Clockwork Constructions in Sydney. Excellent in the sense that picked up the phone 8:30 at night and said, mate, I've got a big problem here. I've got a huge pool of water pouring from the first floor down the second floor. I need an emergency plumber. Either you get one or I'm going to have to get one that's going to get charged back to you, because this property is relatively new, still under warranty. Within 2 minutes, he had someone there. Literally, they lived 2 streets across. It was an air conditioning condenser. They'd isolated that. They're there today right now repairing the carpet, painting walls, etc. But to your point, mate, good people. They're hard to find, but when you get them, I know I paid this builder plenty. He wasn't cheap, but he's excellent.
Insurance job?
No, because it's under warranty.
Oh, okay.
So this is why builder's warranty. Hence why I called the builder.
Yeah, okay.
And this is why. And this is what I knew when I built this property. I went with someone who I knew and trusted. But they didn't charge me half. They charged me a lot of money. But part of that privilege is that you get those outcomes with people. And I'm going to use them again.
Yeah, my computer just ran out of power.
Mine too.
But that's okay. But the point that you make there, and it's all about taking action, right? What do you do with a report like this? A lot of people will use this as a way to go, all right, I'm going to start investing now, and they go and do it themselves. That's sweet. A lot of other people are going to go, yeah, I might use a buyer's agent. That's sweet. The challenge you have is if you're buying property and or involved in and around property management, a lot of people's view, and again, it comes to the point, the trust relationship terms become negotiable. A lot of people think negotiating is trying to get stuff the cheapest.
Yeah.
Right. And that's not necessarily what property investment is about. No. And you just gave a great case study then, right? It's about reliability and predictability, I would say, were the key outcomes that you want in property investment. Now, the Fast 50 report arms you with some information that hopefully you can use that will give you a sense of predictability about the outcome in property investment.
Yep.
And what we're talking about here, these are the best suburbs to invest in today for the best capital growth in 2025. That doesn't guarantee they're going to continue to grow.
No.
But what we're trying to give you is a predictability on helping you channel your money and deploy it in the right way to get as close as possible to a predictable outcome. And that predictable outcome being capital growth.
Mm-hmm.
It's as simple as that.
Yep.
You know, that might mean that you might not get something under market value to the thing that you just spoke about.
No.
That's an upside. That's a nice to have, right?
Yeah, absolutely.
But what we're talking about here is that you're probably going to have to buy these properties at the market value. And what is the market value? It's what something's worth on the day.
Correct.
If you can see some way you can manufacture upside in that to accelerate your equity, great. That might be a renovation, might be, I don't know, you can find something, put another granny flat on it, whatever it may be. You might knock it down and then you put a town on it, whatever it is. It's irrelevant. But the predictability that you want in property investment is the perpetual capital growth in your portfolio. The skill is being able to hold that through good cash flow management, all that sort of stuff. That's all I want as a property investor is predictability.
And Phil, you probably isolated what I think 95% of property investors should want. If they don't want it, that's what they should be aspiring towards, is predictability and perseverance to be able to stay in the game for as long as possible. Because you notice then when we went through all these different data points, we talked not only about what happened in the last 3 months, what happened in the last 12 months, but what happened over the last 10 years. Now, if we went back further and said 20 years or 30 years, those numbers would be very different in every one of those markets. But the key is that you want to be one of those investors who has the ability to hold for 20 years, hold for 30 years and beyond, and potentially be it generational money that goes to the next people and so on and so forth. And you can only do that by predictability as well as good cash flow management. And they're the things that most property investors should always aspire for.
Yeah, it's easy. And I'd probably overlay that with the sooner you can start doing that, i.e. take action,
Yep.
the better off you'll go
Completely.
if you make the right decisions.
Yeah. Yeah, absolutely.
So there's so many unknowns. Anyway, what do people do? People like don't come and talk to me about doing this tactical stuff because I don't know.
No.
I don't even know where most of these places are.
I do.
Yeah,
thankfully.
he does.
And so do my team.
Yeah.
Look, I think firstly, if you've downloaded the report, fantastic. If you haven't, don't stress. You can obviously download it right now. Even if you're not inclined to say, okay, I don't really care what's in the report. I want to know what's right for me. What we really want to do is talk to clients before we worry about which suburb. The report is effectively probably one of the last of 20 steps.
Yeah, this is sort of putting a cart before the horse.
100%. Yeah. So for us, it's saying get in touch with us, or me specifically, if you want to speak with me, purepropertyinvestment.com, inquiry, ENQUIRY, at purepropertyinvestment.com, or give us a call, 1300 985428. Hot tip, if you try to go online to book a meeting and you can't find any space, give my team a call or send an email to that inquiry address, and we should be able to squeeze it in.
What, tell them Phil sent you.
Tell them
You get
Phil
the
sent you.
special calendar.
I'll tell you what, you'd be pushed out with 2025 and you'd be getting the royal treatment there, the squeegee. But if
gosh.
you do find that the calendar's a bit booked up, give us a call or send us an email. We'll make sure you get squeezed in because the calendar's a little bit rigid. You can only pick what's available, but there's ways to get around that. Hot
Okay.
tip.
There you go.
But that is the intention. We want to set strategy to then implement.
Good. Well, hopefully people have enjoyed the last 6 days of podcasts around the Fast 50.
It's been exhausting.
Well, you talk a lot about property. It's hours and hours of
Also
content.
being
there.
in a room with you for that matter.
That's horrible, right? Be surprised how many people say that.
I wouldn't be.
You'd be surprised. But no, people seem to like my company for some reason. It's just mad.
That makes one of us.
Mad. Yeah, no, it's the way it works. But no, thanks, mate. It's been good working with you again on this report. Fast 50 for 2025. Where to put your money today for the best capital growth in 2025. Smartpropertyinvestment.com.au is where you can find it, download it. Questions, send them to editor at smartpropertyinvestment.com.au. I'll get Paul back on. We'll do a bit of a Q&A, answer all those questions. But if you want to go straight to the source, I guess, for more informed discussions around tactical application of the report, how you can take action, or maybe just even stress test or challenge some of your decision making around property, give Paul and his team a call. They'll be happy to chat with you. How many clients do you reckon you've worked with now?
It's coming on 2,500.
God, that's a lot of people.
It's a lot of people. It's
If you lined
very
up-
privileged. I don't say it lightly that it's been a privilege. For that amount of people to work with us and to go down that pathway and buy multiple billions of property over a decade-long period of time, it's been amazing.
How many of them would say, I'm happy in general?
I'd like to think I'd like.
I'm happy I invested in property. There you go.
Yeah, I reckon
Most.
the longer the people have held, the
Yeah.
more they'd be inclined to say that.
Yeah, true.
And that's a bit of a ingest term, but that's generally speaking, the longer they've held, the happier they are.
That's property, and
That's
that's
property.
predictability.
Yep.
Property is predictability. Anyway, it's Paul Glossop, Pure Property Investment. Thank you. Check out smartpropertyinvestment.com.au. Social media Smart Property HQ is where you'll find us. That's it for the Fast 50 special series for 2024 for our report for 2025. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.